Our total return is composed of income return and capital return. What do you mean by income return? Income return is the cash we receive. What do you mean by capital return? This is the change in asset price. For example, an asset could be a house, it could be a company, it could be a share, it could be a bond. So the price could be higher or lower. Therefore, the capital return, if the asset price over time increases, it would result in capital gain. But if the asset price in the future becomes lower, this means that we could have a capital loss. Therefore, capital return could be positive or negative. But what about income return? Income return is the cash we receive. So what would be the minimum? It means that we don't receive any cash. Therefore, the minimum for income return is 0. But for capital return, it could be negative. So let's get an example. Let's assume that a house. You purchase the house today for 1 million. And after 1 year, the house price is worth 1.5 million. Therefore, this is an example of income return or capital return. This is an example of capital return. Why? Because we have a change in asset price. So, what is the return you received here? 1.5 million minus 1 million, it is half a million. But if I want you to calculate as a percentage, so what percent? So you will tell me the formula is new minus old divided by old. I will get the price new, which means the price at year 1, minus price at year 0 divided by price at year 0. If we're going to substitute with numbers, it will be 1.5 million minus 1 million divided by 1 million. This will give us 50% capital return or capital gain. What are the other benefits we receive from a house? We receive rent. Therefore, rent is the cash we receive, which is an example of income return. So let's assume that after 1 year, we will receive a rent of $100,000, which is 0.1 million. So what will be our percentage of income return? So in order to calculate it, I would like to see what is the cash flow we'll receive at the end of the year, which is C1, divided by the initial price we paid for the asset, which is the house here, divided by P0. Therefore, I will get the cash flow at year 1 divided by price 0 at time 0. This will give us income return. Let's substitute with numbers. 0.1 million divided by 1 million, this will give us 10%. Therefore, in this example, when you purchase a house, you will receive 50% capital return as well as 10% income return. Consequently, what will be our total return? Our total return is income return of 10% plus capital return of 50%, which is equal to 60%. So we could use the formula for both income return and capital return, which is C1 divided by P0 plus B1 minus B0 divided by P0. We can get B0 as a common factor, so the formula will be P1 minus P0 plus C1 divided by P0. We can apply the concept of total return on shares. So let's assume that you buy a share today for $10. After 1 year, you will sell this stock or this share for $12. So this is an example of capital return because we have a change in share price, a change in asset price. So what will be our capital return as a percentage? We have the formula, which is P1 minus P0 divided by P0. Let's substitute with our numbers in this example. So it will be 12 minus 10 divided by 10. This will give us 20%. So every time you hold a share, do you receive other benefits except the change in price? Yes, you receive dividends. When a company makes a profit, they will distribute part of this profit as cash dividend. So let's assume that after 1 year, the firm will distribute dividend of $1 per share. Therefore, our income return is cash flow at year 1 divided by P0. We can write, instead of C1, we can write it as D1, which is dividend at year 1. And if you remember from the financial ratios, this ratio is called dividend yield, which is dividend at year 1 divided by price at P0. So with a share, we can call it dividend yield, or in general, we can call it income return. So let's substitute with our numbers here. So we'll have 1 divided by 10, it will give us 10%. Therefore, in this example, we have income return of 10% and we have a capital return of 20%. What will be our total return? It's income return of 10% plus capital return of 20%. It will give us a total return of 30%. And remember, the formula will be the summation of these two formulas. So we will get P1 minus B0 plus C1 divided by P0. We could apply the same concept of total return on bonds. So let's assume that you purchased a bond today at time 0 for $96.62, and after 1 year, the price of the bond is $98.21. So what will be our capital return for the bond? we need to get P1 minus P0 divided by P0. Remember, here we must have a difference of 1 period only, which means if we talk about years, it's 1 year. You cannot do it for 5 years. So let's substitute with numbers. So we'll get here 98.21 minus 96.62 divided by 96.62. So this will give us a capital return of 1.65%. Every time you hold a bond, you buy a bond, do you receive other benefits except the change in bond price? Yes, you get regular periodic coupon payment. So let's assume that at the end of the year, you will get a coupon of $10. Therefore, what will be our income return? It is the cash flow we receive at year 1. Here we can call it the coupon payment at year 1 divided by P0. So let's substitute 10 divided by the bond price today, which is 96.62. This will give us 10.35%. So in this example of a bond, we have an income return of 10.35%, capital return of 1.65%. Therefore, what will be our total return? Our total return is 10.35% income return plus 1.65% capital return. This will give us a total return of 12%. So in bonds, we could have other names for capital return, for income return, for total return. Remember that the formula for total return will be the same of income return plus capital return. So it will be P1 minus P0 plus C1 divided by P0. So for total return, it's also called what? Yield to maturity. Do you remember when we talked about bond valuation and we said that we have bond yield or yield to maturity? So our total return is yield to maturity. Then what's our income return? Our income return is called the current yield, CY. Our capital return is called capital gain yield. Therefore, in order to calculate capital return or capital gain yield, we need to calculate the bond price twice for 2 periods after each other. Therefore, this formula will take a lot of time and it will be time consuming for calculation. So based on this relationship here, can we get a shortcut formula? Yes, I know that yield to maturity is equal to current yield plus capital gain yield. So if we know yield to maturity, if we know current yield, we can easily calculate capital gain yield as yield to maturity minus current yield. And this will be a shortcut formula in order to calculate capital gain yield for bonds or capital return.